Hello and welcome to the Investing Views. Today we're going to learn all about a company's stock float. The lessons contained in this video include what a company's stock float is, how a company's stock float works, high stock float versus low stock float, what is excluded from a company's stock float versus authorized shares versus outstanding shares, and how a stock float impacts the price of a stock. Now let's dive right in. So what is a company's stock float? A company's stock float represents the amount of shares a company has issued to the public that are currently available for trading. It serves as an indication of how many shares are actually bought and sold by the public. The stock float is calculated by taking a company's outstanding shares and subtracting closely held unrestricted shares. Closely held shares may be shares held by employees and other major shareholders, while restricted shares are shares that are in a lockup period following an IPO. The stock float is important for investors to take note of because it shows how many shares are available for buying and selling for the general public. It's important to note that a company is not responsible for how shares within the stock float are traded, as this is a function of most secondary markets. Now let's dive deeper into different stock float dynamics by considering the following example below. Let's assume that Apple has 100 million shares outstanding, but 10 million of those shares are held by insiders who purchase these shares through some sort of employee share distribution plan. Employees are restricted from trading these shares for a period of time, usually up to a year or so, and as such, these shares are considered to be restricted. As such, a company's stock float in this scenario would be 90 million. While there are 100 million shares outstanding, only 90 are available as float for trading. As an investor or trader, it's important to be aware of whether or not a company has a high stock float or a low stock float, as this can have an impact on the price volatility of certain stocks. Given our previous example with Apple, the stock float percentage would be calculated by taking the stock float of 90 million and dividing it by 100 million. This would give us a stock float percentage of 90%, which is considered a high float stock. This brings us to the next topic, which is what actually constitutes a high float stock versus a low stock float. A stock's float is considered high if it has a large number of shares available for trading. In our example, Apple's float would be considered high because the vast majority of the total stock is open for trading. It also indicates that it's easier for investors to buy and sell the stock because there isn't a lot of demand. High float stocks also tend to be preferred by institutional investors like mutual funds, insurance companies, and even hedge funds because they have the ability to purchase large blocks of shares without impacting the price of the stock too much. On the flip side, a stock is considered to have a low float if it has a small percentage of shares available for trading. This happens for a variety of different reasons, such as a large amount of closely held or restricted shares, having a small batch of investors, and many other reasons. A low supply of shares can make it difficult for investors to buy and discourages retail trading. While there's no industry-wide standard for what defines low float stocks, many brokers consider stocks with fewer than 10 million freely available shares for trading to be a low float. A stock's float can increase if a company decides to issue new shares as a method of raising additional capital. It can also reduce the amount of shares available for trading if insiders and major shareholders buy up the shares, or increase if they sell the shares. It's important to note that low float stocks tend to have a higher bid-ask spread and higher volatility than a stock with a high float. Low float stocks can also be manipulated much easier by algorithmic trading and can carry a high level of risk if traders aren't familiar with the float figure. It's also worth mentioning that big changes in a company's float can happen after a lockup period expires, which by industry standard is 6 months following an IPO. If you're considering investing in a low float stock, it's important to be very conscious of 3 main features. These include relative volume, price volatility to news, float percentage, and changes in the float percentage. Relative volume compares how the current trading volume measures against trading volume in the previous period. This figure is important because it can impact the liquidity of a company's trading and showcase to investors whether or not that company is investable. Price volatility to news. How does the price of the stock react to news events? Knowing how sensitive the price of a low float stock is to news will help you assess whether or not you're comfortable for the level of risk that that stock poses. And lastly, the float percentage. Knowing the float percentage will serve as a guide for how sensitive the stock is and how much demand versus supply there is for trading it. It can help you determine whether you should be investing in the stock long term, trade it short term, or avoid it altogether. To better understand the stock float, it's important to know what's actually excluded from the calculation. The main exclusions from a stock float calculation include shares held by insiders, shares held on a company's own books, such as treasury stock, and restricted stock that prohibits the owner of selling it in a given period of time, the most common being an IPO. It's worth noting that some investors adjust their own calculations for how they calculate stock float, but these three are considered the main exclusions from stock float. As we now know, the float represents the number of shares available to the public for trading. Authorized shares, on the other hand, represent the maximum number of shares that a company is legally allowed to issue to investors per its own determinations. The authorized share count is laid out when a company is first created. It's worth noting that a company is not required to issue all of its authorized shares. And lastly, outstanding shares represent the number of shares a company has issued. These represent all the shares that can be bought and sold, including the restricted shares. As such, the float shares and outstanding shares will vary. So how does stock float impact the stock price? The stock float can have a dramatic impact on the prices of stocks. At its core, it's supply and demand that dictates the prices of stocks. To that end, if more investors and institutions purchase shares of a company, it takes less and less demand for the price to go higher. The more scarce publicly available shares become, the lower demand it takes to have an impact on the price of the stock to the upside. That is one main reason why low float stocks tend to be highly sensitive to large order flow. The lower a company's stock float percentage is, the more volatile and sensitive it will be if demand and supply of shares changes. We hope you've enjoyed this video and now have a better understanding of the different dynamics behind stock float and how it can influence the price of stocks. Please smash that subscribe button.